Okay, I've got 3:30 and that's the time we're supposed to start. So welcome, thanks for coming in here. My name is Brian Shannon. We're going to talk about the volume weighted average price today. Who is familiar or uses the VWAP in any way, shape, or form? So maybe about a third of you, it looks like. Okay. So this is, I did a presentation earlier for the CME and it was probably a little bit more advanced. So this kind of slows it down to make it a little more educational. Hello to everybody online too, if there's anyone out there live streaming, listening. So I've been involved in the stock market. I used to do these trade shows, I think, when they first started, maybe 15 years ago. Haven't been to one of these in a while, but good to be back in front of you people, fellow traders and that. So hopefully there's something here I can teach you today to add to your arsenal of trading. Who thinks trading's easy? Good. Me neither. It's very difficult. But I will tell you, I'm convinced that the volume weighted average price will make your decision making easier and more accurate in your timing. I will bet anyone that if you don't walk out of this room without some knowledge, then I lose the bet. But I don't lose anything. But yours is to gain some knowledge. Hopefully I can impart to you. And then I'm going to spend about 40 of the 42 minutes trying to sell you products. There's a little bit at the end. I promise I won't be one of those people. So thanks for being here. Let's jump right into it. The volume weighted average price, I think, is the perfect combination of price, volume, and time. Those are the three most important things in the market. You can ask anyone when it comes to analyzing price, in technical analysis, price, volume, and time. Those are the three things that are most important. So we're going to talk about what is the volume weighted average price, why we use it, from a personal standpoint to a macro crowd perspective. And then we're going to talk about where to anchor from and how to make money with it, because that's why we're here. So let's talk about what the VWAP, the volume weighted average price, is. It's a combination of price. Price is how we get paid. It's objective. You either win or you lose. There's no pat on the back, attaboy. There's no gray about whether we win or lose. Volume shows us the emotional commitment of the participants. How badly do people want to own this stock, or how quickly do they want to get out of it? It's the emotional intensity commitment. And then time is subjective. My time frame might not be the same as your time frame. I was talking to David Keller out here from Stock Charts earlier, and we were talking about, when people ask you, are you bullish or bearish, what an open-ended, meaningless question that is, from my time frame at least. Because, we're in a long-term uptrend in the market, and we're breaking out in several of these markets to maybe starting powerful new legs higher in the S&P 500 and the NASDAQ and that. But tomorrow, maybe we're going to sell off 1.5%, and if I'm day trading, well, I'm bearish as can be. I'm going to be aggressive. So what's your time frame? My primary time frame for trading is a swing trade. The way I define a swing trade is that I start with a larger term time frame to identify the overall trend of the stock. What's the macro, what's going on in this stock? And then I'll look to an intermediate term time frame. So to me, that means a stock with 30-minute time frame, 30-minute candles or 15-minute candles. And I'll look at those and say, where's the potential in here? Where does this stock have the potential to go if I'm looking at it on the long side? What's my risk, theoretical risk? So how do I create my risk reward on that intermediate term time frame? And again, as a swing trader, I generally go back about 30 days to come up with that. And then the short-term time frame is to fine-tune my timing into it. And I'll look at it and say, now I'm going down to a 5-minute, maybe a 2-minute, and if I'm so for swing trade, maybe down to a 2-minute, to really just fine-tune my entry and say, I think I'm getting the best price possible. I'm getting involved as the momentum takes off. I don't have to wait around. So I'm reducing my risk overall by managing my time as well. I'm using time as a form of leverage to maximize my time in the market. That's the point of swing trading. Excuse me. This morning I talked about scalping the E-minis. Now that's, I'll look at a long-term trend there might be the last 10 days. And then an intermediate term might be a 2-minute chart over the last 2.5 days, and then I'm down to a 1-minute chart. We're talking about swing trading here. And again, understand that the concepts are the same regardless of what time frame you trade. If you're an investor, if you're a swing trader, if you're a short-term, scalper, it's all, as they say, fractal. So the volume weighted average price, the way it's represented on a chart, is like a moving average, like any moving average. But instead of being a time-based, fixed 50-day moving average or 20-day moving average, it's from a certain point in time. Where we measure from becomes our anchor. So here's a daily chart, a chart of 1 day. Each one of these candles represents 1 minute. So from the very first 1-minute bar, it's saying that's the average price the business transacted in this stock over 1 minute. As we get the second minute, it adds up all of the volume, divides by all the shares, divides by the cost, and we get this moving property that shows us an emerging sentiment, an emerging value. So when we're above that volume weighted average price, you look at it and say the buyers are in control. It's very objective. There's nothing you can argue about that. When we're below a declining volume weighted average price, we'll see that oftentimes it becomes, tends to act as resistance on the way down. This is just a random day on the S&P 500, again, using 1-minute charts. And most people in here, I hope, aren't actually using 1-minute charts. It's just very easy to make the examples with this. So the volume weighted average price in 1988, I forgot the guy's name, but Berkowitz was his last name, came up with a white paper about how to determine whether you're getting a good execution or not. As, let's say, I'm a manager of a fund at Fidelity. How do I know when I give an order to Goldman Sachs to buy 500,000 shares that I'm getting a good price at the end of the day? Well, so he came up with the benchmark, which was known as the volume weighted average price. It was a fixed thing at the end of the day, where they'd say the volume weighted average price was 101. The stock traded between 100 and 102, let's say, and the VWAP just happened to be in the middle. I'm just making this up, of course. But if Goldman Sachs came to me at Fidelity and said, "Hey, you bought your 500,000 shares at 101.20," I'd be like, "Dude, what are you doing? You kind of blew it. I paid an extra 20 cents per share on a 500,000 shares. That adds up. It's eating into my returns." But if they came back and said, "We filled you at 150 cents," hey, great, I saved 50 cents a share versus what the average participant could look for. So that's how it started out. It wasn't till maybe early 2000s it became an analysis tool. The first time I had noticed it was in 2006 on a trading platform called Realtick, where I noticed it said VWAP and there was a trend line I could draw. And I just kept drawing this trend line and noticing that it would act as dynamic support and resistance. It would move up and down, but the buyers would emerge. Anyway, so because of that, now the way that an order for 500,000 shares gets executed is they'll get a guaranteed VWAP pricing, for instance, where Fidelity or Goldman will say, "We'll guarantee you volume weighted average price for the day." Well, how do they do that without putting themselves at too much risk? Do they want to put themselves at risk because they have a hotshot trader who can beat the VWAP and make that, if the VWAP was 101 and Goldman says, "Okay, we're going to guarantee you at the VWAP," instead they buy it at 100.5, well, they get to keep that 50 cents per share. So they're incented to be really good traders. Or do they want to just say, "Hey, listen, this is a tough stock. We're going to let the algos run it. We're going to cut it up into 5-minute slices, and we're going to say, on average, in the first 10 minutes of the day, the stock does 8% of the volume." So they're going to buy 8% of that 500,000 share order in the first 5 minutes, and on, so they don't create a market impact. They just want to be average. Isn't that pathetic? But that's the way it is. So that's kind of an advantage for us as traders, that we can try to be better than that. All these machines are running the market, but if we know what's running the machines, why can't we anticipate what they're doing and try to figure out the logic of it and use that to our advantage in any time frame? Because it's not just, hey, buy me 500,000 shares today. It's an investment committee that works over the weekend and says, next week we're going to buy another 1.5 million shares of Amazon, and we want to get it at VWAP or better for the week. So you'll see that the week-to-date volume-weighted average price becomes something that acts as support or resistance often. You'll see it on a month-to-date. You'll see it on a year-to-date volume-weighted average price. The point is, though, it's a great reference point to say who's in control from any particular point in the market. You can use it on any time frame. I'm using examples so far, 1 minute, but again, it doesn't matter if it's weekly candles. What it does is it allows us to look also at volume. Volume, it's bullish when it goes up on big volume. But have you ever noticed the big volume comes at the end of the trend? And when oftentimes I used to have this problem where I would be looking at a chart and it's starting to break out on a shorter term time frame. I want to get involved, but I'm looking and saying, I got to wait for volume. Volume confirms I need volume. Well, by the time the volume comes in and the news comes out, the move is over. So price is what pays. We have to look at it and not look at volume traditionally. And this is an actual chart of the S&P 500 where we saw, this day it was down on real big volume. Then it was up on lighter volume than the previous day. Then it was down on big volume. And people say, hey, it's down on big volume. That's a problem. That's a warning sign. But if you look objectively at the same thing, here's the volume weighted average price from that time. So during those 4 days, who was in control? Does it matter if it was down on big volume on Tuesday? If we see that on Wednesday, the average price continues to move higher, it gives us a true assessment of who's in control. Because maybe that big red volume, occurred it closed down, but it was up most of the day. 80% of the volume might have actually occurred at higher prices when it was positive on the day. So it just gives us a little bit better, accurate picture of what this, who's in control from a certain standpoint. So the anchoring bias is, Daniel Kahneman was a psychiatrist, actually, who won a Nobel Prize in economics for his work in heuristics. Heuristics is, biases. So the anchoring bias was one of those that he spoke about. And the anchoring bias is, what's the most important in price to anyone? Myself. If I see, so they've done studies about this. If I said to the room, look at this house, this is worth $250,000. Now, what do you think it's worth? Estimates will go between maybe 220 and 280. But if I said this house is worth 300, I've anchored in your mind, kind of like a magician's trick where they, use deception and look over here, look over here. Your estimates will be between 280 and 320. So you're anchored to that first price. That's why everyone likes a sale. Hey, it's on sale. By the way, Alpha Trends, my subscription service, is on sale at the end of this. It's $7.99 regular. Remember that number. You're going to get a good deal. You're anchored. So price has memory is the point. What's the most important price? A lot of people say it's the closing price. The closing price is the stupidest price there is. You can't act at the close. It's closed. You can't do anything. The most important price is, where is it right now when I'm looking at it, compared to what? Compared to the volume-weighted average price for the year? Compared to what an analyst said it's worth? Compared to what some fund manager said he bought it at or thinks it's going to get bought out at? No, the most important price is relative to what I personally paid. Am I winning or losing? This is a me-centric business in the market. We're not here to make friends. We're here to make money. And if I buy a stock at 100 and it goes to 80, I feel like a dope. If I buy it at 100 and it goes to 120, it confirms I'm a genius. These are facts. It's like dollar cost averaging. If you look at, this is Apple over the last 6 months. If you took $1,000 per share, $1,000, and each month on the 15th bought $1,000 worth of Apple. 7 months ago, you would have bought 5 shares at $199.23. Then 6 months ago, you would have bought 5.2 shares. Last month, you would have bought 4 shares. You would have bought less shares because the price is higher. But this is your dollar cost average. That's what you have to report for your tax basis. That's how much you paid. That's your VWAP. That's your volume weighted average price. So the way, again, that it's represented is as a moving average. Who uses moving averages on their charts? Pretty much everyone, right? And most people use, I find most people use a simple or an exponential moving average. Sometimes people will be, extra smart and use a time displaced moving average or some weird moving average that nobody else uses. But what's the value of a moving average? It's a reference point, something to compare price to. Right? So we either use a simple, we use an exponential, or we use the volume weighted average price. The volume weighted average price is the true cost or short price from an actual point in time. So when we look at a 50-day moving average, who uses the 50-day moving average? And why do we use the 50-day moving average? This is something I talk about once in a while, right? There's 252 trading days in a year. When do companies report earnings? They report earnings every 3 months. 3 months of trading activity is 63 days. That's 3 months. January to the end of March, on average, is 63 days. Why aren't we using a 63-day moving average instead of 50? Because that's when we have an actual significant event. Corporate earnings are reported every 63 days. 50 days, I use a 50-day moving average because everybody else uses a 50-day. I mean, does anyone have an actual reason why 50 is the magic number? It's crowd behavior. It's a self-reinforcing, it's a self-reinforcing concept. That if you are buying the stock, you say, or if you're not in the stock, you missed it, it pulls back to the 50-day moving average. Hey, it's its 50-day moving average. Now's my chance to get in. Well, if you were over here and you're an aggressive fund manager and you're shorting it, you say, I'm going to short it down to the 50-day moving average. But when it gets to the 50-day moving average, I know there's usually buyers there, so I'm going to cover. I'm going to add supply higher, but I'm going to get demand at that 50-day moving average. What about a big fund manager who bought 5 million shares down here, sold 500,000 shares on the way up, and says, I'm going to buy another 300,000 shares to support it at the 50-day moving average because that'll give other people confidence to go in there and buy that. If you don't think that happens, think again. So it becomes self-reinforcing, and then all of us are like, hey, it's at the 50-day moving average. The 50-day moving average, to me, is a great reference point. So is the volume-weighted average price. It's not necessarily an action point, but it's a level of interest. Okay? People will say, hey, it's at support. Nonsense. We don't know if it's at support till it's bounced and gone. We don't know if it's a double top. I mean, how many double tops are diagnosed in an uptrend? Just because it hit the same price as before. That's not even the definition of a double top. But the point is, it's a potential area where the sentiment might shift. So it's a level of interest where we say it's at its 50-day moving average. Let's look at a shorter term time frame, so, to really see what's happening here. And that's the way I view the volume weighted average price. Whether I'm anchoring from the beginning of the day or if I'm anchoring from an earnings report, from a Federal Reserve announcement, basically what we want to look at is what's the direction of the volume-weighted average price? If it's rising, well, the buyers are in control from the point where you anchored it. Okay? Now, you might have anchored it a week ago, but over the last year, it's still in a downtrend. So there's a confliction of time frames. What we want is trend alignment. Here's another plug, my book, Technical Analysis Using Multiple Time Frames, How to Profit from Trend Alignment, okay? That is what we're looking for, is we're not looking for mixed messages on different time frames. We're looking for alignment where we can get in at a low risk, high probability point and limit our risk as much as we can. So a neutral similar to the 50-day moving average. The stock is going sideways above and below it. You look at it and say, well, this doesn't make sense. Well, yeah, it does make sense. It's telling you stay away. It's neutral. There's no reason to do anything. People criticize moving averages because it might be, it's crossing up above and below and say, oh, those moving averages are useless. It's not useless. It's telling you it's digesting here. Leave it alone. Let it figure itself out. In a downtrend, it tends to act as resistance. The direction of the volume-weighted average price is what we want to look at. Here is a chart of, I think this is Amazon through 2 days ago. And here we have a 50-day moving average. That's the blue line. And, has it really been of value over the last year? I mean, it bounced off it there nicely. That was good. And kind of right there. Then it sliced down through it. And it does a pretty good job. But if we want to know, are the buyers back in control? We take a VWAP off of that prior high, and we can see that it acted as resistance there, and now it's acting as resistance. And maybe it's starting to flatten out and get ready to turn higher once again. It's not there yet. How about gold? Does anyone own gold or trade gold? Okay, gold, I think, okay, so here's a 50-day moving average. By the way, one of the most common questions I get is, where do I get an anchored volume-weighted average price chart? Okay, this one's TrendSpider. They have this. If you right-click on the chart, you'll see it says anchored VWAP by Alpha Trends. That's me. Thanks, TrendSpider. So in TC2000 did the same thing as well, as they have the anchored volume-weighted average price by Alpha Trends, and it allows you to point and click from any point and say, I want to know what's the average price paid, transacted, because it's not paid, it could be sold too. We could, have shorts in there. It's the average price it was transacted at. Well, here we have a blue 50-day moving average, a black 50-day exponential moving average. But what's most important about gold this year is when gold started making this rally. It rallied from this May low. And from that May low, the average price that gold has been transacted at is pretty much where we closed today. So some people will say gold's broken, it's in a downtrend, forget it, it's all over, because it's closed 3 days below its 50-day moving average. I'm going to tell you that now is the key level. If it closes below here for 2 days, below that volume weighted average price for 2 or 3 days, I think the gold is probably going to drop right back down into a boring range. But what I think is most likely is that this is going to be an opportunity to trap people who've been tired of holding gold because it's been doing nothing for 2-3 months, bring in some new short sellers, and if it bounces from here, from this failed breakdown, I think you see a quick move back up towards that 145-ish level. This is GLD, by the way. It's the ETF for gold. ATVI. So if you look at volume-weighted average price levels, what they'll show you is what become hidden, or what you wouldn't normally see, levels of support or resistance. So this rally in ATVI from 2017, it broke down hard with that gap. And now we can see that the stock has been, this is through yesterday, they had earnings last night or this morning. It was only down slightly, so it really didn't damage this chart. But this is the key level it's trying to get through. Now, buyers regained control right in here when it closed above the volume-weighted average price from the peak. What did that say? It told us that the average price from the highest point, the average participant is now okay. They're not hurting here. They're actually making money. If you dollar cost average, like we saw in Apple, you would have bought a lot more shares down here because it's a lower price. And now the average price it's transacted at from that peak is tied with the volume-weighted average price from this low. So that tells me that here this prior traditional resistance has become support. If it breaks below there, I don't think you want to own ATVI. I don't care what the story is, how many gamers there are out there. So you've got about 10% of downside, but if it can get above these 2 points, you'll probably see the stock go back to that $80 level. So, but you can't see that here without anything. And if I was to outline 50 and 200-day moving averages, you'd be squinting to see where the logic is. Let's look at a couple more examples. where to anchor from. How about buying the dip? Everyone likes to get a bargain in the market, right? This is Twitter. So the boxed in area up top is from the September high. And you can see that red dot that connects from that that top red candle. That's the volume weighted average price from that high. So prior to the earnings misstep, or whatever you want to call it here, the sellers were in control from the September peak. News and surprises tends to follow the direction of the trend. It gapped lower, and people said, hey, wow, it's 32 bucks a share. It was just 50, 40, whatever. What a bargain, right? Well, no. Since that event, we still have sellers on balance. So the average bargain hunter feels like a dope right now. Or they're in denial and saying, oh, I just need patience, that's all. Why not wait for confirmation that the buyers, that we at least have an equilibrium and it gets up into here, and then we start to see this volume weighted average price hold as support. And then we can then we have a logical place for our stop as well. But when it's in free fall, where's your logical place for a stop? Is it below this low? Okay, gotcha. If you used it below this low, they got you there on a gap, they got you here on a gap. Now, if it gets back above this resistance at that VWAP and holds there, well, we can put our stop below here. So it's about identifying who's in control. Why be early? As it's said, I like to repeat this a lot, it's better to be on the sidelines in cash, wishing that you were in, than it is to be in the market and wishing you were out and thinking, why did I buy this? What a dope. I'm the dope here. Don't be the dope. I think I should rename this talk and say, don't be the dope. Use VWAP. So what is a measurable event? This is a stock that gapped lower over here. This is a daily time frame. Anyone want to guess what this stock is? What? It is Apple, yeah. And it was actually, it's about 4 months old, so I removed the name because I was lazy and didn't want to come up with another example. But the point is, it's not being lazy. It's emphasizing a real point with the largest stock on the planet, right? This is December of last year when things were falling apart. It gapped lower, and then we saw our December bottom. Well, when do we decide to put an anchored VWAP there? For me, typically right around here. I'll say, okay, the buyers are in control from that point. It's starting to make higher highs and higher lows, right? It's just stair-stepping higher. So that becomes an important point for me to look at. Well, as we get more data points, it becomes less sensitive because the law of large numbers, or if we have divided by 30 days, it's going to be more responsive than divided by 100 days, right? So we then look at it and say, what's the next event? Well, the next event was this next gap higher, and that was an earnings report. And on that earnings report, the buyers were still in control. It gapped up, and then the buyers remained in control up until that little shakeout right here, that one-day close below it, and then the buyers came back in. Well, guess what happened there? That was, from failed moves come fast moves. We had a shakeout. So the buyers, so what we're looking at here is sudden shifts in sentiment, right? That's what's happening here. Something caused people to dramatically look at what they value shares of Apple at. And it could be Apple, it could be whatever stock it is, the littlest penny stock, whatever the point is, we want to look at sentiment areas. And again, that's what, you can talk till you're blue in the face about how you're bullish Apple when it's in a downtrend, but it won't mean anything. And surveys will say, hey, I'm bullish Apple. Well, so what? What is actually going on with people who have money in the market and who's controlling these trends? Well, from that shakeout, we put another VWAP on that. I did this morning with real live data with the S&P 500. And if we have time, I'll show you how that worked out this morning. It was magnificent. So we anchor from here, and let me just continue with Apple and then right away, because we'll keep it. So again, we had a pullback. The buyers stepped up at that volume weighted average price, so we put another one. And what can we do? Well, we can put our stops underneath these lows, right? Underneath these trailing volume weighted average price levels. It's a way to protect your profits. It's not going to get you out at the high. No stop does. but it's going to give you a systematic approach to managing your profits. People say the winners take care of themselves. That's not true. You have to manage them. You don't just let it go on autopilot, because you could wake up, they gap down, and it's all taken away from you. You had a question? This is daily. Each one of these candles represents one day. This was December, and I think that was through about June or July. That's the volume weighted average price anchored from that point. So then the purple one is anchored from that point. So it's calculating the average price from this point forward. It will, well, what charting platform do you use? There is a script that you can add on. Just Google Think Script. And he's got it here, so yeah. Let me continue with this. Yeah, you can do it on any time frame. Let's look at Bitcoin. Anything, right? So this is, again, TrendSpider. They're great for having the Bitcoin data. We saw a breakdown last year, and then the sellers kept emerging at that point. And then we had this low. So this was the real event. That was the big breakout last year, April, in Bitcoin. We'll look at how it was supported at the volume weighted average price. And then, it broke down through it, and it came to the volume weighted average price from the low. We had a quick shakeout. This was 2 weeks ago. We ran right up to the volume weighted average price from the peak, and now we're testing this one again. So my thought is this is traditional prior resistance. Looks like it might want to hold support here. If it doesn't hold here, I think that Bitcoin is going to limp slowly into year end. If it can hold here, then maybe we can rebuild energy for a push past that 10,500 level and probably go challenge all-time highs. But it's still righting itself from the sell-off, basically, is the way. There's still that dynamic shift. If we look at, this was 2007, support broken tends to act as resistance. This is the NASDAQ. Back then, they used to call it the QQQQ. And you saw that the volume weighted average price acted as support. Support broken tends to act as resistance. We can see that on a 1 minute chart. We can see it on a daily time frame here, where this stock kept finding buyers at that year-to-date volume weighted average price over and over again. What do you think a 50-day moving average would look like? It would look probably like this, and then maybe it touched it, and then maybe it's kind of capping it a little bit. But the point is, it doesn't matter what the time frame is. Here's another one where that support was broken and it was lights out. The average participant was losing money. I saw the other day that Uber's been below its volume weighted average price from the IPO from day one, basically. But now it's below the average price that was paid in the last VC round in 2014. If you've been holding Uber for 4 years and you're now able to sell your stock and you're at break even, are you gonna break even, or are you like a believer? I'd get the hell out of it, But maybe that's the contrary signal. I don't know. What do I know about Uber? Their drivers use way too much cologne. Generally speaking. Here's another one. So this stock, was holding that support nicely. It broke down. Then we put an anchored VWAP off the top, and now it's finding resistance. Who wants to guess what stock this is? This was through 2 days ago. It's $300 or so. It's Netflix, yeah. So Netflix is still in trouble. It's not a bargain yet. It's still being sold. And will this red volume weighted average price from that July high offer resistance once again? It's at an important level. If it can get up to that green volume weighted average price, well, maybe you got 10% of upside, but still it's iffy. It's still kind of doing that balancing act. If we can we just hold the questions to the end? I saw a hand go up over here. I'm going to answer the question. Yes, we can hold them to the end. This is a neat little trick for IPOs. This is shares of Beyond. It's a 1 minute chart. This was the first day it traded. I took a picture of this because I was trading it, And one thing I noticed about IPOs is if you anchor from the very first trade, what happens on that first trade? You have all these orders that are matched. So Beyond opened significantly above its offering price because that's where the market makers match the orders to find liquidity to get this thing trading. Well, those are all matching orders. They're not actual trades in the market. It's that big opening block. So that really isn't free trading. The second minute is where the real trading begins. I know that sounds crazy, but if you're really short-term trading, I'm trying to give you an example of this as well. Notice how, an hour in, it pulled back exactly to the second minute volume weighted average price. So that's important on day one. On day 2 or day 3, it's not as important, so we just anchor because we've got so many, we had 2 pieces of data we were averaging. Now we have, 500 pieces of data. So we switched to a 5-minute chart. My basic guidelines for what time frame to anchor on is go as short as you can to see what you need to see, up to the point where you can still see the individual candles. It doesn't get so scrunched together where we have 10,000 candles all squished together. Instead of 10,000 1-minute candles, we should have 1,000 10-minute candles or something, just so it makes more sense. But 3 days or 2.5 days into it, you see that that Beyond opened on a gap lower right to the volume weighted average price from the IPO. It said there's still strong demand for this stock. Hurry up and take a picture. Okay. So that was 3 days later, and that became a significant event. So we put a volume weighted average price on that because here's a new move beginning from from the very short time that this stock has been in existence. At this point, 3 days, we put a volume weighted average price on that, and look how it respected that volume weighted average price twice before it broke down and then failed, and it broke below the volume weighted average price from the IPO. Fast forward a little bit, I believe this is a 195-minute time frame, which sounds like a weird number, but let me just give you a quick side lesson, is that, again, go to the shortest time frame you can without scrunching it up too much. If I use daily candles, it would be this many candles, because there's 390 minutes in a day, so divide that by 2, 195 minutes is an exact half day. I don't use hourly charts. I just skewed the results. Who uses hourly charts? A lot of charting platforms force you to use a 60-minute time frame. But if you're going to use any kind of indicator, especially if you're using stochastics, MACD, whatever, what you're looking at on 60-minute charts is you have 7 candles per day. One is from 9:30 to 10, and then you have 6 more that are 9 to 10, 10 to 11. So what you have is 6 apples and 1 orange, and you're giving them all, and you're saying they're all the same. And they're not the same. So instead, what you want to do is you want to either look at 65-minute charts, because there's 6 equal periods per day, or you want to look at 30-minute charts, because there's 13 30-minute periods. 13 times 3 is 390. That's how many minutes are in a day. 78 divided by 5 times 5 is 390. 26 times 13 or 15 or whatever is, so you want to put them in increments divisible into 390 minutes per day is my point. So it sounds like weird numbers, but they're actually logical. So Beyond breaks down, it had that first break below the volume weighted average price, and then it gapped up on, McDonald's was testing a couple of their stores, but that got sold into, and now almost everyone is down big in this stock who bought it in the aftermarket. The sentiment sucks. The average person, they loved it for a while, couldn't get enough of it, but now the average participant, unless you bought it in these 5 or 6 days, you're losing money. The average participant, though, from the IPO owns it at about 138, and here we are at 80. It's a piece of garbage stock. And I've heard the meat doesn't taste good either. I'm not brave enough to try it. The fake meat, the vegetables, disguised as meat. Here's another one. It works great on IPOs is the point I was going here, and I should have introduced that better. But when you have an IPO like this one, you look at it with nothing, and then people will say, hey, let's buy it on the breakout above 12, because that's where we have confirmation the buyers are in control. Well, what if we say, let's buy it as the buyers actually regain control? The volume weighted average price was lower, and it pauses there. This is where the buyers regain control at $11.10, not at $12 per share. That's a big difference, paying $11.10 today versus $12 tomorrow. That's what is that, 8% higher. I'd rather sell part of my shares to those breakout people because they'll typically pull back. Okay, so how are we doing on time? I think this goes till 4:15, so, 5 minutes. I was right on with that. Okay, so I got my 5-minute warning in the background too, so that was good timing. So from the IPO, support broken tends to act as resistance. It's pretty basic stuff, but it's based on what is the actual positioning of the people who own the stock. It's not based on what an analyst said. It's not based on some arbitrary time-based moving average. It's based on what is the true sentiment. What is the psychology of the average participant in this stock? If you owned it at an average price of 54, like everyone did over here, and it breaks down to 53, and then it breaks that next ledge, do you feel good about it? Do you want to buy more? Or are you saying, oh, wait a minute. Look, the chart's breaking down. I'm the dope. I better get the hell out of here quick. How do you think an aggressive hedge fund looks at this? They look at this and say, ooh, yeah, let's just smash bids. We've got 1 million shares short. Let's just smash bids. Let's keep an offer hovered above this and scare the crap out of everyone looking at their level 2 and scare them into selling this, and let's get them to panic lower, and then that big volume comes out at the bottom, and that's when they cover. That's smart money. Smart money isn't always the hedge fund, because there are, otherwise every hedge fund would be up 25, 8, 30% every year. Smart money is anyone who's just smart about the market. It's not about how much you have under asset management. It's about how well do you objectively look at the market. So when we look at the volume weighted average price, again, you can look at it. I showed you today on 1-minute charts. I showed you on, I guess, daily charts, and actually weekly as well on the ATVI. So we looked at 1-minute charts, we looked at 5-minute charts, 10-minute charts, we looked at hourly 195, and we looked at daily and weekly. It's valuable on every single time frame because you can quickly, objectively say who's in control from any point. Now, if I put a VWAP on every one of my purchases, it doesn't make it important. It's only important to me. That's my anchored bias. But where is the crowd anchored to? Where is value for the crowd? Where do they start to feel pain? The average participant. What I didn't talk about, I talk about sometimes too, is we can use it along with short interest to say, what's the average price that shorts are positioned at? That way we can say, okay, now the shorts are getting squeezed because they're losing money. Use it from the opening of the day, from an earnings report, year to date, from any gap, from swing highs, swing lows. Here comes the super hard sales pitch. I've had alphatrends.net as a subscription service for 10 years or so. I don't really talk about it a lot. If you follow me on social media, if you want some, to look at my work, Twitter is @alphatrends. What I do each and every day is at the end of the day, I do about a 2 to 3 minute video, and I review the S&P 500, the NASDAQ, the Russell 2000, the XLF, the financials, the biotechs, and the semis. And I do that in about 3 minutes. Each and every day I say, here's the intermediate term trends. These are the important volume weighted average price levels. Here's our bias for the next few days. At about 5 p.m. Eastern, I have another video that's about 6 to 10 minutes long, and I talk about 5 or 6 stocks, and I say, these are stocks that look like they're set up for a swing trade. Here's why. And I go through that same stock on maybe 5 or 6 different time frames. I show you the logic behind each trade. I say, here's where you might want to put your stop if you're a very aggressive trader. Here's where, if you want to look at it because it has longer term potential, maybe you want to put your stop, below this high or low. I don't tell people what to do. I'm not a certified financial planner. I'm not here to tell anyone what to do. I'm here to guide you and say, here's a good risk-reward ratio. Each day then at about 11 a.m. Eastern, I record another video that's about 3 or 4 minutes long, and I say, here are where we should adjust stops. Here's why we took a third off at this price. Here's what's going on in the market. Let's tighten our stops up so we anticipate. That's it. It's normally $7.99 a year. I do a webinar every other Monday where it's interactive. You can ask me, hey, what do you think about this chart? I didn't understand that concept about the VWAP from this point. Could you go over that? $599 a year. That'll be good for the next, I think they told me 8 days. I don't know. It's probably longer if you email me. And we are out of time. So alphatrends.net/599 special. Thank you, everybody, for being here. Hope it was valuable, and I'll be around after you want to chat a little.